Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for February 14th, 2015. We have a market that is in bullish normal conditions. On an annual basis with weekly RSI 14, it's at 61 out of 100, so at the higher end of neutral. On a 10-day basis, it is overbought using the 10-day NDX at a score of 99 out of 100. With the market mosaic, price relative to the 200-day moving average is white bullish at 6.43%. Slope of the 50 has improved to yellow neutral at plus 0.12. ADX remains weak, trending at 15. The risk index is the VIX 30-period moving average divided by the 10-period. The threshold between risk on and off is 1.0. The current reading is 1.10, so that puts us into risk on conditions. We take that score of 1.10, compare it to the last 5,000 trading days, and find the standard deviation. An average that gives us a risk z-score of 1.13. You can see the 90-day time series of that indicator here, and we've crossed over the zero line into risk on and are now 1.1 standard deviations above the 5,000-day average. That favors the long side. Monthly rebalancing still in place. Next reevaluation on or about 1 March. These are the current leaders based on closing prices as of last Friday. Within ETF2, the theoretical exposure increases to 90%. The model portfolio will be exposed at 100% by adding a position in PFF, the U.S. preferred stocks, and a second position in SCHB, which is a broad U.S. market cap weighted. The Kansas City workshop for research weekend and live trading week is on for 5 to 12 June. We have more than enough people to lock in the hotel. We've got all of the meeting rooms reserved, so we have plenty of room for folks that want to come out for one or both of those events. Just a quick look at the ETF 13 and 32 portfolios for blended monthly rebalancing. So almost everything is now on a buy position except for ILF, which is still suffering. ETF Max represents the top 50 ETFs in the BMR database of about 1,300 funds. This shows you who the true leaders are. Across the board, the FTSE in Europe is looking interesting here, green and white. Looks like perhaps biotech is cooling off a little bit here with BBH. As are some more biotech in India cooling off. These are the S&P 500 leaders using the BMR lens. We're interested in those that represent new strength, and that would be green and white. So things like Harman International. Newmont Mining is very interesting here with green and yellow. So that may be a sign of a turnaround here in XLB. So we'll take a look at mining, Newmont Mining and Vulcan Materials carefully. Amazon doing well. Coles and Corning, Boeing, CF Industries, and then Bemis Company, Inc. This is the market health check for as of Friday. The vertical blue lines are 10, 20, and 30 days worth of look back. This is 60 days, this thicker blue line. The purple horizontal lines were price targets when price had been in the sideways chop here inside the river, which is the dark blue shaded area. 30-period Bollinger Band plus or minus 1. The lighter blue shaded is the floodplain. That's Bollinger Band 30 plus or minus 2. And we were looking at breakouts above these two purple levels as being indicators of perhaps the next leg up being ready after a triple bottom here. Actually quadruple, 1, 2, 3, 4. Would it stay within the channel, start to break out the last 2 days showing the way up? It's in the green, so My auto position here is to be long intraday as soon as I can. As soon as the market justifies a long side position, I'm long. We've broken out of the floodplain and above an all-time new high here. So these pullbacks would be seen as noise, and maybe this is just some market rebalancing, backing and filling, accommodating or digesting the falling oil prices. But there's some signs of stability and return to normalcy there, and Russia making nice with its neighbors as the next tactical political play. And we've seen that the slope of the 30-period regression line has now crossed back over the zero line and is now as steeply up as it's been in the last 50 days. So I take that as the sign of a breakout that has consolidated without really threatening more than about a 4% sell-off in here. So that's perhaps the next leg up in this aging bull. Perhaps this is the beginning of the next little baby bull, and this was simply the time that it paused and refreshed. You can see the 200 period moving average is this red line in the shaded area underneath. I want you to notice that the RL30 slope turned at a significant level. It turned at about minus 0.2. Minus 0.22 would be steeply down, and so this little turning point here gave us some warning about potential goodness right in this region. Plenty of time to get on board and start posturing for the next move up. If we get above here, I'm looking for the next leg to be at another $10 to the upside. So 220 is within sight on this next excursion, based on the size of the moves that we've seen in previous gains. So that represents about a 4 to 5% bounce, and that's the next price target to the upside. The jaws of PPO, percent price oscillator, open to the upside. They had also warned early in this move up. This was failure to fail inside here. It held at the edge of the dragon and continued to go. So I look at all this as very favorable. This little choppy area, you can see, was quite a different look than we saw in the previous gain period on percent R. And so now we can see that the market can stay overbought for quite a while. So if we could get a 30 days worth of move in here, that's where I'm estimating my plus 5% move up to 220. ETF regional report coming from the ETF2 lens. EFA has shown some recovery here as Europe tries to dig its way out of the hole and Asia stabilizing. Only Latin America remains on a cash position, so that puts us at 90% invested, 10% cash in the theoretical model, up from 80-20. EFA at 77 is now better than the S&P at 68, which is a shift in strength. We haven't seen that for at least 8 months. Inside the U.S., it's the small mid caps at 70, followed by the techs at 68, large caps at 68, and small caps at 67. A mixed bag now inside the U.S. with energy, industrials, and utilities leading the way. Still some longer-term strength residual in discretionary and consumer staples. This is the world market model. Everything in the U.S. is above average except for the large caps, or for the value side on mid caps and small caps. Everything else above average. Latin American emerging markets starting to do better. Canada lagging a little bit. Japan above average. Asia less. Japan below average. China and Indonesia leading the way in Asia. And a number of the European countries now have moved across the line into above average. Top 30 ETFs using that ETF2 lens. See, this little tactical bounce in oil has helped. Here's the U.S. preferred index along with South Africa. The industrial and energy sectors doing okay. The green and white ones, green on the strength, white on consistency, are the new leaders. So total market index, I take that as a positive sign for the broad markets in general, which is why we're accelerating our exposure a little bit in ETF2 to 100% instead of 90. The dollar up is still good. Utilities are holding their own. If we get a broad expansion in equities, I don't know how much longer that defensive play will be any good. So I'd be looking at locking in, preserving profits if you have some in that sector. Dow 30, United Tech has just been punished here quite a bit. Microsoft down in the red, along with Caterpillar and McDonald's for the bottom feeders and value plays. 3M is white and yellow, which is a sign of new strength early in the business cycle. Verizon, green and white, and then the two longer-term winners, Walmart and AT&T, that are both solidly in the green. So you can see the U.S. industrials have been cooling off a little bit here. ETF liquidity, just for your reference. Shifting to the daily now. We've got some channeling and overreaction candidates on the ETF side, along with a triple screen in real estate, and then auto framers for treasuries, gold, the VIX, Merck, American Express, utilities, Alcoa, and silver. And a potential short side signal in EFA. I would wait to see evidence of market failure before I got back on that, because that's been, this little tactical bounce has really been actually healthy for it, and so I don't want to get in front of a turnaround play there. But if we saw market weakness and EFA was worse than the S&P, I think you could play that on a tactical basis. But I'm definitely leaning towards the long side now on the basis of the risk Z and the broad index improvements. Tactical summary, handful of good frog candidates here. You can see the leaders from Friday: Chevron, Microsoft, Caterpillar, and UTX. Now, that makes Microsoft an interesting play, given that it was at the bottom end of the Dow and yet had a good day on Friday. Perhaps there's some value opportunities inside Microsoft. From the ETFs, you can see a couple channeling and overreactions here with treasuries and utilities, and strength here in the energy, oil, and coal. I still think there's more room to mine inside there. All of these that are in the green are things that have closed above the previous trading range, whether it be 10 days, 1 month, or 3 months. And so, as an example, EWJ at 116, Japan had a really large relative bump, as did Technology XLK. That's an interesting play for the sector as well. 3 on the RSI2 that signaled with a score of 10 or below, so that's going to be utilities, treasuries, and the VIX. Auto framer and regression line fractals for your reference. You can see the acceleration out of this little choppy area here based on the last 3 days. This was failure to fail at the logical place. You can see we're still early in the slope improvement of the RL30, and this zooms in on that a little more carefully. You can see we're just at the 6-month average on the 10-day, and we've just crossed over into the upside, and we've still got room to go. Price relative to the 200-day moving average, we are just at the 6-month average here, so we are not overdone by any means. This is starting rather than ending. And that's everything I want to show for today, and I'll have more to say tonight during the webinar for members. So, and we'll frame some trades going forward, looking both intraday and swing. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.